subscribe now and press the bell icon. Never miss an update.
This is all about like what needs to get capitalized, what needs to get expensed. So we know all the rules, right? What are the expenses associated with buying of an asset or installation, and then regular repairs and maintenance or the regular usage will go towards maintenance, which is not a capital expense, right? And then we saw if there is a liability which is assumed with a mortgage, then that gets added to the basis. Okay, if there is a lump sum purchase, then we need to go with residual method, meaning that if there is a one amount given to different kinds of assets to buy different kinds of assets, so like the entire is getting sold, and obviously one purchase price has been decided, then how do we apply what basis to which assets? Because later on, if we want to sell off any of those assets, we cannot say that we don't know the entire company was bought for $1 million. So now, how do we make sure? And out of that plant and machinery, if we are planning to sell, then how do we make sure we are getting the right basis for that? You can apportion it, you can try to do different things, but what actually the rule says? The rule says that we need to go with residual method, meaning that there are certain class of assets from 1 to 7, and this starts from the most liquid asset to less liquid, then further less liquid and all, and then these are the ones. Point number 4 and 5 are all other assets, which could be like land and property and machinery and all. Then we come up to section 197, which could be patents, covenants and all, which are intangibles. In the end, we come to goodwill. So this is the order that we need to follow. We cannot say out of 2 million, first I'm going to apply $500,000 towards property, then I'll see we are left with 1.5 million, then I'm going to see what to apply to which assets. So we have seen this example that we need to go with these classes and all, and whatever is left with, that goes to goodwill, the residual value. If the purchase price, if the sale price is less than fair market value of all assets, then obviously first we will go with the most liquid assets. We'll keep applying basis to them based on their fair market value, right? But then there will be a difference because total FMV is 550, but we are getting paid only $450,000 for a total assets of value of 550. So there is $100,000 difference. That $100,000, how do we split it up, or like how do we make sure it gets applied to the total assets worth 550? And that's what we saw, that we have to go with the categories. So everything until inventory has been taken care of, equipment and land, they belong to category 5, right? How? Because this is what it is, all other assets. Property held for sale, that becomes inventory. So this all comes under category 5. So what we'll do is we will take the remaining value, the residual value, will apply it to all the assets in the category 5 in the ratio of their fair market value, based upon the relative fair market value. And that's how we'll do that. Okay, that's what we saw. Then we saw sale of stock and all. Usually, if we can match what stock we are selling, we'll take the basis for that. If we cannot, then we'll follow FIFO method. Demolition cost always gets associated with land. Property which is received as gift. Again, this is a bit complicated. You guys need to maybe spend some time, but quickly I'll go through the rules. That first of all, if there is a gift tax paid, we have to make adjustment to the basis. There could be two values. There could be fair market value that we need to consider as on the date of the gift, or there could be donor's basis. The person who is donating the property, that person must have bought that property for a certain amount, and he must have made the adjustment to the basis over a period of time. Regardless, the basis of that person will be called adjusted basis or donor's basis. It gets compared with fair market value. We need to see what is the lower of that, any gift tax paid, that needs to be adjusted, and that's how we come up to the basis. We did certain examples. We did like 4 or 5 examples yesterday. I think that made it quite clear. Then there is another situation if the FMV is less than donor's basis. That's also quite possible if there are stocks which are bought and they get lower down in the value, and the person wants to donate those stocks. So the basis for that donor is going to be higher, but FMV is going to be lower. In that case, we will have loss basis, gain basis, and no gain, no loss kind of situation. No gain, no loss basis. Okay, it all depends. Later on, see, when do these basis things will make sense? When the person wants to sell off the property later, then they need to come up with all the calculation that what should I take as the cost basis, because if I don't take correctly cost basis, then the capital gains may not be computed correctly. And that's what we did. And there could be a gain, there could be a loss, depending upon how the sale has been made later on, and we'll have to apply the basis as per that. Maybe we can just go over one of the example. Okay, this one we'll go with, because here fair market value is $60,000, basis is $80,000. It is sold for $75,000. Shweta, can you explain how much gain or loss will be there?
There's no gain and no loss because the sale value is between FMV and AB.
Good.
This is a wash sale. Wash.
This is a wash sale, correct.
Yeah.
So there's no gain, no loss. And that's how the rules are. Now, if you want to get into why it is like this and all, that we'll have discussion later. But that's how we have to first see whether FMV is higher or lower than the basis. If FMV is lower than the basis, the rules are different. So what is the gain here, Garima?
5K.
Is that a gain? Is that a loss?
It's a loss.
It's a loss. How?
Since the FMV is higher, so the lesser of the FMV and AB should be taken. So we will take 10K and is sold for 15. Therefore, it's a gain of 5K.
Correct. The donee assumes the lesser of the FMV or the donor's basis. So here donee will go with 10,000 and the donee is selling it for 15,000. So it's going to be a gain of 5,000. If the property is transferred for more than FMV at the date of the gift, but for less than donor's basis, there's no gain or loss is recognized.
Okay.
That's the wash. There's no gain, no loss. If the FMV is less than the basis, then you need to go with those rules. Otherwise, it's the lesser of the two. So here also FMV is higher than the basis. Forget about this gift tax and all. Here FMV is $100,000, basis is $40,000. Later, let's say it gets sold for 60,000. The donor's basis is used if the property is transferred at a gain. If the property is later on, in this example, we assume that the property is getting sold for 60. Now, if the property is getting sold at 120,000, greater than FMV, greater than basis, then is it a loss or gain? I mean, obviously it is a gain only. Now comparing all the numbers, it is getting sold at the highest price. So obviously it is a gain. But how much would be the gain?
It will be taken on donor's basis.
Basis. Again, let's read this thing.
The donor's basis.
Perfect. Why? Because that's how IRS can get more in revenues. Because the situation is when the FMV is more than basis, then you use, if it's a gain, then you use basis. So if it's getting transferred at 120 minus 40 is 80,000 will go for taxes. Versus if you use FMV, only 20,000 is taken for taxes. But if it's a loss, then we are using FMV.
So what is the difference in second and fourth one?
The difference is the situation. Okay, there are two major situations. Like you need to just you need to put them into two different categories. One is where FMV is lower than basis. Sorry, higher than basis. In both this situation, FMV is higher than basis.
Right.
And the other situation is when FMV is lower than basis. And then here FMV is going to be higher, so we'll have to see whether should we go with FMV as the basis or the donor's basis as basis for donor. This is a gift tax calculation, so don't worry about that. Let's go to the next topic, which is like if there is property received for services. So we know that we have also read about it earlier also. If there is any property received for services that is form of ordinary income, gross income, okay, that gets taxed, and we'll have to see what is the fair market value of that property versus what the person has paid if they've acquired that, or if it's if they didn't pay anything, it's just given to them as compensation, then entire fair market value of that property will be taken as the basis for them. So later when they are selling it off, they can see what was the fair market value as on the date when they received it, and accordingly can do their capital gain or capital loss calculations. But the fair market value will get added to the gross income, and the person needs to pay taxes on that. But the principles are same. Whether you receive cash, it will be taxed the full amount, and if it's a property, you need to assess what is the fair market value, and everything will go up as compensation income or salary income, and the person has to pay full ordinary taxes. But if that person is paying taxes on fair market value, then obviously that fair market value becomes basis of that property. Accordingly, we will always take what is the basis, and then we will make the capital gain calculations. Okay. Okay, the only difference is that this property is given as compensation or as in lieu of cash. But then the principle is same. If there was cash given, that would also be taxed at the ordinary rate. Property is given, we don't know how to tax it, so the rule is simple, that go with the fair market value as of that date, and then make sure that we are the person is paying taxes on that particular value. The value may go down later on, it may go high, but that fair market value becomes the fixed basis, and all other further gains or loss calculation needs to be done by taking this into consideration. Okay. So let's go to the next one, inherited property. If the property is inherited, typically we'll go with FMV on the date of the death. That becomes the basis. But there is only one situation here, that the executor may elect, they may say that I don't want to take fair market property on the date of the death. I don't want to take the fair market value on the date of the death. So there is a flexibility given to them. They can choose something called alternate valuation date. They get 6 more months. So the property will be valued 6 months after the decedent's death. So they have some kind of room there. They have some flexibility that either whenever the death has happened, to take the fair market value as on that date, if the property is inherited, or we can go with alternate valuation date, and we take it 6 months later, the date of the death. But if the property is sold within those 6 months, okay, let's say somebody is inherited, they don't want to keep it, they're like, okay, after 3-4 months I want to sell it off, then obviously 6 month later date and later value will not make any sense, right? So if the assets are sold within the first 6 months, then basis equals fair market value on the sale date. Then we just stop there. We don't have to go to all the way to 6 months. We just stop there. We say, okay, what was the fair market value as on that date? Let's take that as the basis. And same basis rule will apply if this community property interest, that means kind of joint property, and or any other form of ownership, they're getting it and all. But what we need to remember is the FMV rule does not apply to any income in respect of a decedent. That means if the person has died, but that person was actually eligible to receive certain income and it came in later after the death, then we cannot say that, okay, we'll apply FMV rules to that. It will go with the whatever amount it has come in. Any appreciated property decedent within 1 year of death. So that person has received some property within 1 year, I mean, like 1 year before, or 1 year is not even over and that person died. So we cannot go with FMV rules there. We just have to see what was the basis of that property given to the decedent. That means, like, because a lot of times people do all these things, they say that, okay, this person is anyways on deathbed, going to die, so we don't have much time, let's do all that planning. So a lot of things will be transferred or said given as a gift, because when this person dies at the time of inheritance, then you receive everything on fair market value, so basis goes high. It's always good to have high basis, so when we are selling off those property, our gains are minimized. So this rule can be misused and all, and that's why IRS is saying that, okay, within 1 year, like if you have done something before 1 year of the date of the death, then it's fine. Maybe you don't have a control. It's like nobody can imagine that this person is going to die within 1 or 2 years. But you actually know a person is fighting within 1 month, 2 months, anything can happen and all, and then we are doing all this transaction. They will not go with the FMV rules. This is very commonly done. So those are the exceptions. If the property is transferred 1 month, 1 year before, then it's fine. What they're saying is go with the regular rule. Let's take what is the fair market value. A shareholder must report his or her rateable share of any income that is income in respect to a decedent, IRD. We have read about it. That means, like, any income which the person was due for that year, maybe there was some receivables that person had received after he or she died. Right, so that goes for a different rule, because that will come up as a regular and ordinary income. Final return still has to be filed for that person. Let's go over this example: tax basis for inherited S corporation stock. Okay, if the owner of the S corporation died, then how the stocks would be inherited and what becomes basis for that stock. So Raksha, you want to read this 9.3?
Okay. The shareholders' basis in the inherited S corporation stock is its fair market value on the date of death minus the rateable shares of any S corporation income attributable to those shares. Fair market value is 5K at the time of death, 2 shareholders, K1 income 2K, fair market value for 1 shareholder minus 2.5K minus 1K.
What is the basis in the inherited S corporation stock? Okay, what is the shareholder basis and all? The shareholders' basis in the inherited S corp stock is its fair market value on the date of the death minus the rateable share of any S corp income. So that income will, because see, if we are taking fair market value on date of the death, that means we are already incorporating income component in it. Correct? Because that's how it becomes fair market value. That's how we say, oh yeah, the company is having so much of profit sitting in its sitting on its sitting in the on its books, and that's how we are computing fair market value. So fair market value will anyways account for that profit whatever has been accumulated. It's just that when the K1s are issued, the profit goes on K1, right? When the share of the profit goes on K1. But then fair market value already includes that, so we have to minus that part. So if the example is, if the fair market value is $5,000 and there are 2 shareholders, so that means, and total K1 income is 2,000, so one shareholder will receive 1,000. Let's assume they're 50% shareholder. So 2K gets divided into 2 people, 1,000 each, and fair market value is 5,000. So fair market value for two people will be, sorry, for one person will be 2,500. 2,500 less we will do K1 income, so it becomes 1,500. Because this K1 income will anyways would be considered as ordinary income. So the firm, we are going with that rule that just take the market value. Fine, we'll take that. But this is a S corporation. That means S corporation has to distribute its profit. It's not a C corp where it can keep sitting on the books, and if they want to declare dividend, then only it has to distribute. So we'll always have to do this adjustment. Tanya?
The basis of inherited property. A purchased 10 shares of ABC Inc. in 1980 for $200. When A dies in the current year, she leaves the stock to her grandson B in her will. At the date of A's death, the stock has a FMV of 1000. The estate has not elected an alternative valuation date. B's basis in the stock is 1000.
Can you try to explain?
So if you have not used an alternate valuation date, the FMV is always the date of death. So on the date of death, the FMV is 1000. So the basis for the stock will be 1000.
Perfect. Perfect. Yeah. Shweta, 9.5.
I have a question here. So, Nitika, the difference between $200 and $1,000, which is 800, who is going to pay tax on that?
So he has purchased the shares for $200, but he dies, she leaves the stock to grandson. Nobody's going to pay taxes.
So it's a loss for government. In
Yeah,
India,
it's a
they
loss
say
for government. It's a loss for government. That's why they're saying that inheritance. So this is inheritance. It's not going to be taxed at the like the perfect way. So that's why they're saying that do not transfer anything in last 1 year and all, because that time will not take fair market value. Yeah, so that is a loss to the government, but there is a death which has happened, so we cannot. I mean, like, this becomes a bit sensitive, right? So one can always say, well, I didn't know that the person was going to die, right? So there the rules are a bit relaxed. That if it's inheritance, just go with fair market value, and that could turn out to be advantageous. Let's go with the next example.
A purchased 10 shares of ZXYZ Inc. in 1980 for $200. When A dies on February 1 of the current year, she leaves the stock to her grandson B in her will. At the date of A's death, the stock has an FMV of $1000. The FMV of the stock remains unchanged until October 1 of the current year, when the FMV of the stock declined to $80. The estate has elected the alternate valuation date. So B is basic. Okay, so A dies on February 1. So 6 months from then it will be July, and it says that the stock remains unchanged until October 1. Therefore, the basis will be $1000 since FMB was $1000.
Correct. So the after 6 months, it is still same FMP. So either we go with the date of the death or we go with the alternate valuation day, which is going to be 6 months after the date of the death. So even though the value in October went down, but for their purpose, they will still take a basis of whatever basis it was as of 6 months after February, which is going to be August 1st, right? Or July 31st. Okay, so if no federal state tax is required to be filed, the value is appraised for state inheritance tax purposes. So we are saying that there is a situation when when there is no need for federal state tax return to be filed. So we still might have to file state return. I mean STAT. Okay, the different states in US. They say California returns may still need to be filed, even if there is no federal return to be filed. And the value as appraised for state purpose needs to be used. And again, we cannot say that we will go with the same rules for state as well, because every state may have their own rules when it comes to inheritance. We are just reading about federal rules here. Most of the state, in most of the situation, they try to follow federal, but remember, US is a US is not a parliamentary system, it is a federal system. That means all states, they're free to do so. They don't have to follow federal. That's not the case in India, right? Central will give limits to states, or central will allocate some budget, or central always has the upper hand on the different states. But that's not the case in US, because they don't have, they are following federal system. So we can never assume if there is an inquiry, or if there's a, client is asking that this is what it's going to be, what does your law says? Like for example, QSBS up to $10 million, the entire gain could be waived off. It's not taxable, but that is for federal purpose. The states may still charge some taxes. So we have to see from both angles. Okay, fine, federal, yeah, you may get some benefit, but what is happening? Which state do you live in? Are you in, maybe you are in California, the rules are different. If you are in New York, the rules may be different versus Arizona or somewhere else. So we always have to look at the state rules as well. There are certain states like Florida, Texas, Washington, they don't have income tax at all. So people don't pay any taxes, they don't even file tax returns. They just have to file federal and they're done. But there are certain states like California, New York, and all, they're charging up to almost 9% in income taxes. So those states are very expensive. Dividends, if they are issued in the form of stock, a corporation recognizes no gain or loss on transaction involving its own stock. Obviously, the corporation recognizes no gain or loss. But what about the person who is receiving the stocks? Does that person recognizes any gain or loss? That's what we'll look into. And if yes, then what would be the basis? If no, then does the basis change? Because if I'm already having 100 stock, let's say the stock went for split, and that 100 becomes 110, 10 is to 1, or 10 is to 1 split, then does my basis change for that 110 stock? So tomorrow when I'm selling just 10 out of it, what should be my basis? Can I take that, okay, basis for those extra 10 stock is 0 and 100 would be whatever I've paid for? No, it doesn't work like that. We have to proportionately distribute it. And that's what we will look here. So proportionate distribution of stock issued by the corporation is generally not gross income to the shareholders. Any proportionate distribution, if there are 100 shareholders, all shareholders get the same kind of stock, so their percentage of holding in the company stays same. It's not like one person has increased shareholding, one person has diluted their share, right? Because there's a proportionate distribution. Everybody gets same, and that's what happens in stock splits. All the shareholders on the record will get extra shares as per the ratio they decide. Or if there are any bonus shares issued or whatever, right? So if there is a proportionate distribution, then it is not an income. It's just that, yeah, your number of share earlier was 100, now it is 110. But the shareholder has to change their basis. A shareholder allocates the aggregate adjusted basis in the old stock to the old and new stock in proportion to the FMV of the old and new. So what shareholder, this could be a bit confusing when we read it like this. What we need to see is, what were the old stock, what was the fair market value of that, or what was the basis of that, and what is now the new stock, okay, and what is the FMV of the old and new stock. So the earlier basis that the shareholder has for the old stock, that will get applied to the new stock in proportion to the FMV, because there is no basis for the new stock. They have been given this stock for free. So we are still not changing the adjusted basis. What we are saying is, if the basis was $1,000 earlier, the basis will still remain 1,000. But earlier it was 1,000 for 100 shares. Now it is 1,000 for 110 shares. But how do we give the value to those 10 shares? Now they're saying, okay, you bought these 100 shares 10 years back. There's a different basis. The new shares, 10 shares, were given to you in today's date. So let's look what is the fair market value as of today. And then we have to use that proportion. So we'll do some examples that will make it clear. Basis is apportioned by relative FMV to different classes of stock. If there are different classes, also common stock, something else, or convertible, non-convertible, whatever. So, those also we need to see what is the relative fair market value. The holding period of the distributed stocks includes that of old stock. So the holding period will be considered as same as that of old stock. And earnings and profits are not altered for a tax-free, so there is no dividend. It's like the company's earnings and profits, they are not altered, because it's just that earlier company had a issued capital of say 100,000 issued capital, total stocks 100,000. Now they're making it 200,000. So every stock is split into two. But there is no impact on earnings and profits. So it is not going to be a taxable transaction. Now there's something called stock rights. They are given the rights to acquire stock. And the distribution of stock right is also treated as distribution of stock. But again, if everybody gets it, then generally if everyone gets the same amount or same proportion, then it is not considered to be taxable. So a distribution of stock right is treated as distribution of stock. Basis is allocated based on fair market value. Again, we are using the same concept here. Okay, there's one change here. The basis in stock rights is 0. Stock rights meaning they are given this, like there's a form of dividend only, but it's in the form of rights, right shares. So what they're saying is the basis could be 0 if the aggregate fair market value is less than 15% of the fair market value of the stock in which they were distributed. So if the difference between these two values is less than 15%, they say that basis in the stock right will be 0. So if the aggregate fair market value, we will take fair market value of all the stocks now what we have. And then we are going to compare it with the fair market value of the stock on which they were distributed. What was the fair market value of only those original stocks you had? If the difference is like not too much, it's less than 15%, then they said, okay, don't, you just have to make your basis as 0. Okay, basis in the stock, if the right is exercised, is any basis allocated to right plus exercise price, that's all fine. Holding period will, if they have to exercise something, if they're exercising the right, then we have to see what is the exercise price and all. And that could be a different thing. So if they're exercising, saying on this particular day that, okay, I want to exercise and I want to get the stocks, then we have to see the holding period should begin from the exercise date. Here what we are saying is holding period would be same as of original stocks. There's slight difference in these two, but both of them are pretty much non-taxable transactions. Now this is going to be taxable. What is it? So distribution of stocks are subject to tax. The amount of distribution subject to tax is fair market value. This is fine. We have seen the example of RSUs, stock options. They're all taxable distribution. Again, there's one more condition. If the distribution of stock can include the shareholder has an option to choose. They can take stock, they can take some property, they can, they have some flexibility there, then it will usually be a taxable transaction. Here, they don't have any flexibility. Whosoever are the shareholders on the register, company will see, okay, what is your holding? Your proportionate distribution will be done. So your proportionate shareholding will still be same. It's not like the shareholder will go and tell them, well, don't issue me more stock, just give me cash for that. If they have structuring it in a way that the shareholder gets that option, gets the flexibility that, okay, instead of stock, give me some other property, something else, then it becomes a taxable transaction. For example, some shareholders receive property, some receive stock. And some received common stock, some received preferred stock. And usually that happens when they are when they want to compensate people. So based on how much they want to compensate or how much incentives the companies want to give to their employees, they may have a different distribution. That maybe person at a very junior level will get only so much of stocks, but person who is like running the entire company may get very high number of stock. So distribution of preferred stock is made with respect to obviously preferred stock only. And what they're saying is limited change in conversion ratio by itself will not trigger liability, and also that's fine. You know what, we'll just go over some of the examples, then it will make it more clear. So what we need to see here is some shareholders are receiving property, some are receiving stock, some they may choose for some other class of stock and all, then it becomes a taxable transaction. If it becomes a taxable transaction, that means ENP on the books also needs to be changed, adjusted. If it's a non-taxable transaction, we are not even touching ENP. They're not altered. Okay. So basis in the underlying stocks does not change because now these are all considered different transaction. Basis in the underlying stock will be whatever they want to keep, they have it. But whenever the new stocks is issued, then they have to go with the FMP. We are not now like going to club everything together and say that use the ratio of fair market value and spread it over all the stocks. Because this is a taxable transaction, what has been put up as tax, that can become the basis. If the distribution of stock dividend and stock right is taxable when received, the basis is the FMV on the date of the acquisition. Okay. If it is going to be a taxable transaction, then it gets taxed based on the fair market value on the date of the distribution. We have seen when RSUs are given, as of July 31st, if RSUs are given, we have to see what is the fair market value as of that day. That becomes taxable. And if that amount becomes taxable, then that also becomes the basis because they've already paid tax on it and then they bought it for themselves. You know, essentially, like, I mean, constructively, you need to think of it that somebody is having an income, they pay tax on it, they're left with post-tax income, they go and buy a property. So it's the same thing. Stock split, if you are splitting up the stock, then it's obviously not a taxable distribution. Just that the number of stocks changes. Okay, and holding period of new stock will include that of old stock. Okay, let's go over these examples. So the first example, listen carefully now, everybody. 4 shares of common stock, you know, for, I mean, let's say the shareholder had 4 shares of common stock for $200. Okay, that is the basis. So the person, they bought 4 shares of common stock for $200. And later the corporation issued preferred stock. Okay, they distributed preferred stock for every 2 shares of common stock. So, and on the date of the distribution, at date of distribution, the common stock, let's say it has a FMV of 60 per stock. So when the person bought it, they bought it at $50 per stock because the person bought 4 shares. When the distribution happened, they are being issued preferred stock for every 2 stock of common. That means this person is getting 2 extra preferred shares because he's holding 4 common stock. Okay, so we'll see what is the fair market value. At that point of time, the fair market value of common stock went from 50 to 60 and preferred stock had a value of 40. So what is the basis in common stock and preferred stock? Okay, we'll just see what is the basis in common stock and preferred stock. Write this down and let's try to see if we can do the apportionment based on the fair market value. See, what he is acquired with is $200. Now this $200 was the original purchase price. He's getting 2 preferred stock for free. We still need to go with the same basis, but now this basis needs to be distributed among common stock and preferred stock. But in what ratio? The basis is still going to be same. Earlier 4 shares had $200 basis. Now it is going to be 4 of common stock, 2 of preferred stock with still a basis of $200. It's just that we need to split up that basis so that we know what is now the basis for common stock and what is the basis for preferred. And assume this is going to be non-taxable. Because if you assume it to be non-taxable, then all we are doing is we are changing the basis as per fair market value ratio. So based on these prices, fair market value, so we are saying that for common stock, now they're going for $60 per stock. So how much it is? 240? Because they're saying fair market value of 60 per stock for common stock. And preferred is 2 preferred stock, 40. Correct? How much is the value?
80.
80. So we got 240 and 80. Any hint?
1/3 of the price.
Yes.
3 times.
So what will it be? So what will it be? So now we got the total value of how much? Total value of all the stock is how much? 320? 240 plus 80. How much it is? 320, right? And now 320 needs to be divided in the ratio of the fair market value. So what we'll do is, the fair market value of common stock is how much? 240. Divide it by 320. Okay, and what was the original basis? 200. Because we cannot change the original basis. What we are doing is we are taking the fair market value of common stock, fair market value of preferred stock, that comes to 320. Now we'll see out of what is the ratio, the 320, how much it needs to go towards 240. And then Garima said is 3:1. Right, so this will give how much?
150.
150. Correct. So 150 is for common stock. Then how much will be for preferred stock? Remaining is 50 for preferred stock. It is still giving us the same ratio, 3:1. Okay, so we have to see what is the fair market value ratio for both of them. That's going to be 3:1. So the total basis still stays same. And now you apply 150 to common stock and $50 to preferred stock. So later when we are selling those stocks, at least we know what basis to take. So 150 common stock is for 4 shares of common stock. $50 preferred stock is for 2 shares of preferred stock. Right, we are taking, is that clear for everybody? Let's do one example quickly here again. Again, see, corporation declared and distributed stock dividend of 1 share for each 10 shares. They are giving the dividend. Anybody who's holding 10 shares, they'll get 1 share as dividend. So some person, they had 100 shares. Okay, so that if they have 100 shares, they will receive 10 additional shares. Is that right? We understand this much? Yes, dividend of 1 share to 10 shares. So now if they have 100 shares, they get additional 10 shares. So total share now they have in hand is 110 shares. But the original basis for these shares was $550, 5.5 per share basis for 100 shares. And now when they receive 10 shares, the market value of one share went up to 60 per share. So what is the basis for 110 shares? And here, one thing is that stock dividends are not taxable, but only basis needs to be adjusted. So earlier we know that $550 was the basis for 100 shares. Now we have to figure out the basis for 110 shares. What will become the basis for 110 shares? Stock dividends, we are not taxing it, okay? There's no taxable. So we are not going to take fair market value of 6 times 10 is 60. We are not, this is not taxable. So what we are doing is actually it's very simple. What is the total value on hand? The basis will not change. I mean the basis per share will change, but total basis will not change. What is the total basis? Correct?
Madam, the basis for per share will be $5.
Very good, Varunji. This is perfect answer. And can you please explain how did you do it?
Since the basis needs to be adjusted only, it will not change.
Yes.
So the value for 100 shares previously was $5.5 per share, that is $550. And the same value will be adjusted to the 110 shares. So it will come to $5.
$5. Yes, and that's what it is. So now 110 shares get per share basis of $5. So if he wants to sell off only 10 share, then the basis becomes 50, cost basis. So it will be 5 per share, right? Let's do one quick last one. This is again simple, not that complicated. We just have to think again properly. So what happens is some person they purchase 300 share at 120 per share. Okay? And later on the same person bought additional share at 180. So first 300 shares were purchased at 120. Write it down in your notebook. Okay, 300 shares times 120, that was the cost basis. Say after 6 months, whatever, the market went high, 120 became 180. So this person thought, okay, that's still a very good price. Maybe it will go further higher. They bought additional shares of 180. Okay, and now 20% non-taxable stock dividend is issued. So what is the total share the person has now? 400, right?
20% of 400.
Correct. How much will that be?
80. Okay.
So 80 shares for stock dividend, correct?
Right.
And this is non-taxable. So now we need to see what is the new basis for that.
Okay.
Now we cannot, we have to say because these were bought at different prices. Okay, so we need to consider those prices. So, okay, let's say for 300 shares, okay, 20% was issued, 20% is 60. And on 100 share, 20% is 20. That's how we became to 80. So 360 share, earlier they were having 300 shares at the rate of, at the rate of 120. How much that is?
36,000.
36,000. Now they have 360 shares. Sorry, 360 shares for the same price as 36,000. Correct? Because 20% stock dividend is issued on this 300 shares. So this 300 becomes 360, but the basis remains same. So how much is the price now? How much is the new price?
No, but 100 additional was bought, right?
Sorry?
Additional 100 shares were bought, right? And then 20%
No.
stock
We
dividend
are
was
not going to
included.
that part right now, Tanya. What we are trying to just see that originally when this guy purchased 300 shares, 20% non-taxable dividend is given on all the shares, but now since they were bought at different prices, we need to split up into two different groups and then see. So 36,000 was the basis for this transaction. And now these 300 shares are becoming 360 shares. So the basis of these original shares became 100 per share. But what happened with 100 shares which were bought like 6 months later, okay, or maybe whatever months later, I'm just making it up. So that time when they bought it, times $120, how much did the person bought it for? Sorry, 180. How much did the person bought it for? 18,000.
18,000.
So now how much does that become? The total shares now became, after stock dividends, total shares
120.
became 120. So if we take 18,000 still as basis, divided by 120, how much does that come to?
150.
150. So our answer is that 360 shares should have basis of $100 per share. So it will still be 36,000. We are not changing the aggregate basis. Now 120 shares.
Ma'am, amount will remain the same.
So 120 shares, yes, should have basis of
150.
150 per share. So how much does that come to?
18,000 again.
18,000 again. So that's what we are saying, because this is non-taxable stock dividend. The aggregate basis is still same. So now the basis will become 100 per share. Earlier it was 120. And that becomes very important, because it's not like the person will go and sell everything in one shot, right? If they just want to share 50 out of this lot, then how do we come up with the right capital gain? We cannot take 120, because there were 20% stock dividend was also issued on that. Is that clear? Okay, I hope everybody understood this. We are going to close it over here. Any questions? The principle that we need to remember, if it's a non-taxable transaction, adjust the basis. Aggregate will stay same, per unit may change. If it's a taxable transaction, even the aggregate value will change. Why? Because something is offered for tax. We are paying taxes on that. So then whatever we are paying taxes on, that becomes our new basis. Here we are not paying any tax. So just your unit price, you cannot adjust the entire thing. Or if you think you are getting something, as a lot of value and whatever, then you pay tax on it. But this is going to be non-taxable stock dividend, because everybody is getting in the same proportion. Remember, the value of the company is $1 million for 100,000 shares. Now the company is issuing stock dividend. The value of the company still remains 1 million, but now the number of issued capital is say 150,000 stocks. So we are not changing the value of the company. We are changing the unit price. Okay? Okay, then we'll stop here.